In this video, I am going to discuss about fiscal policy. Fiscal policy refers to the use of government spending and taxation to influence the economy. The government uses fiscal policy as a tool to stabilize the economy by adjusting taxes, government spending, and transfer payments in response to economic conditions. The main objective of fiscal policy is to achieve full employment and price stability in the economy. Fiscal policy can be divided into two main categories, expansionary and contractionary. Expansionary fiscal policy, also known as loose fiscal policy, involves increasing government spending and or decreasing taxes to stimulate economic growth. This can lead to increased aggregate demand, which can boost employment and output. However, it can also lead to inflation and an increase in government debt. Simply, in the expansionary fiscal policy, government is spending more on the economy and reducing the taxation so that the money circulation in the economy will be increased. As a result, aggregate demand will be increased. This will lead to inflationary situation. Contractionary fiscal policy, also known as tight fiscal policy, involves decreasing government spending and or increasing taxes to slow down economic growth and curb inflation. This can decrease aggregate demand, which can lower employment and output. However, it can also lead to lower inflation and a decrease in government debt. In a contractionary fiscal policy, government is decreasing the spending and increasing the taxes. So the money circulation in the economy will be decreased. As a result of that, the aggregate demand will be decreased so that the inflation curve will be slowed down. The government can use fiscal policy in many ways to stabilize the economy, such as providing stimulus to the economy during a recession, funding infrastructure projects, increasing transfer payments to low-income households, and implementing tax cuts or increases to influence the level of economic activity. Now let's talk about taxes. Taxes are a financial charge imposed by the government on individuals, businesses, and other entities to fund public services and programs. Taxes are typically collected and managed by the government's tax agency. Taxes can be levied on various forms of income, property, sales, imports, and other activities. There are various types of taxes that individuals and businesses may be subject to, such as income taxes, sales taxes, property taxes, and import taxes. Each type of tax has its own set of rules and regulations, and the tax rate may vary depending on the type of tax and the income level of the taxpayer. Purposes of taxation. The purpose of the taxes is to raise revenue for the government, to fund public goods and services, such as infrastructure, education, and national defense. Taxes can also be used as a tool for economic and social policy, such as redistributing wealth and promoting certain industries, as giving subsidies. Taxes are also used to regulate economic activity and promote social welfare. The tax system is also a means for governments to fund social welfare programs and redistribute wealth. The collection of taxes also serves a means for governments to regulate economic activity and promote social welfare. These are the main purposes of taxation. Now let's look at how the taxes are divided into direct and indirect. Direct taxes. Direct taxes are the taxes that are paid directly by the person or entity that is liable for the tax, such as income taxes and inheritance taxes. Direct taxes are usually considered to be more progressive because they are based on the ability to pay. We will talk about the progressive taxes later in the video. Indirect taxes. Indirect taxes are taxes that are paid indirectly, usually through the purchase of goods and services, such as sales taxes, value-added taxes. We also know this as VAT and excise taxes. Indirect taxes are usually passed on to the consumer in the form of higher prices for goods and services. Indirect taxes, on the other hand, are considered to be regressive because they take a larger percentage of income from lower income individuals than from higher income individuals. Now let's look at how the taxes are divided into progressive, regressive and proportional taxes. Progressive taxes. These take a larger percentage of income from high income individuals than from low income individuals. The idea behind progressive taxes is that individuals with higher incomes should pay a greater share of their income in taxes because they are able to afford it, such as federal income tax in the United States and Canada, where the marginal tax rate increases as the income increases. Here is an example so that you will understand the progressive taxes. Let's consider country A. Income tax for individuals are as follows. If the income of an individual for an year is less than $25,000, the tax rate is 0, which means they do not have to pay income taxes. If the yearly income is between 25,000 and 50,000, the tax rate is 2%. If the income is between 50,000 and 75,000, the tax rate is 3%. If the income is between 75,000 and 100,000, the tax rate is 5%. Likewise, as the income increases, the tax rate is increasing. As the income decreases, the tax rate is also decreasing. This is called the progressive tax. Regressive taxes. Regressive taxes are taxes that take a larger percentage of income from low-income individuals than from high-income individuals. As examples, VAT, sales taxes and excise taxes, which are often applied at a flat rate regardless of income level. Most students get confused with the flat rate and the regressive rate. Let me explain to you with an example. Let's assume there is a country A and VAT on 10 litre of petrol is 10%. This 10% is a flat rate, which means on every 10 litre there will be a 10% of VAT. Price of the 10 litre petrol is $200. This includes the VAT. Then tax on 10 litre of petrol is equal to $200 into 10%, which is $20. Let's take John and Mark who are living in country A. John is earning monthly income of $1,000 and Mark is earning monthly income of $2,500. They both buy 10 litre of petrol each, which means John is buying 10 litre and Mark is buying 10 litre separately. Now we have to calculate what is the percentage of the tax on their income level. That will be the regressive tax rate. So for John is paying $20 for 10 litre of petrol and we divide it by his monthly income, which is $1,000. Then we multiply it by 100% to get the percentage. So the percentage will be 2%. For Mark, he is also paying the same amount of VAT on the petrol, which is $20. We divide it by his monthly income, which is $2,500. Then we multiply it by 100% to get the percentage. So the percentage will be 0.8%. Now look at the income levels of each individuals and the percentage of tax they are paying. For the VAT, John is earning less but paying the high percentage of tax, whereas Mark is earning higher than John but paying lower percentage of tax. These are the regressive tax rates. So don't get confused with the VAT amount. You always have to calculate the tax rate on their income level. That will be the regressive taxation. Now let's talk about the proportional taxes. Proportional taxes, also known as flat taxes, are taxes that take the same percentage of income from all individuals, regardless of their income level. For an example, a flat income tax rate where everyone pays the same percentage of their income in taxes. So if the flat income tax rate is, let's say, 5%, everyone is paying 5% on their income. The percentage is not changing. So it is called the proportional taxes. Now let's recap today's video. We discussed about the fiscal policy. Fiscal policy is where how the government is spending on the public and how the government is raising funds through the taxes. Then we discussed about the taxes. Based on how the tax is paid, we divided taxes into direct and indirect taxes. Direct where the individual or the organization is directly paying the taxes to the government. For examples, income tax, capital gains tax and inheritance tax. Indirect tax is where the individual or the organizations are not directly paying the taxes to the government. They are paying the taxes indirectly. For examples, VAT, sales tax, excise tax. Then we divide the taxes into based on the tax percentage as the income changes. Progressive tax is where as the income increases, the tax percentage also increases. For examples, progressive income tax. Regressive taxes is where as the income increases, the tax rate decreases, and vice versa. For examples, VAT, sales tax and excise tax. Proportional tax is where the tax rate is flat for everyone. For examples, flat income tax. Thank you for watching. See you in the next video.